Today, we're bringing back Zillow's senior economist, Orphe Divounguy, to discuss why now may be the best time to purchase real estate and why waiting could be a mistake. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today, Orphe and I get into many of the big picture forces impacting the housing market. We discuss housing market supply, demand, rental demand, building starts, and so much more. So stick to the end because we even get into if we'll see mortgage rates decrease or increase from rate cuts. Orphe, welcome back to The Real Wealth Show.
Thanks for having me.
Oh, it's always so fun to have you back. And there's a lot going on with housing, as there always is. So let's start with the big picture. Where are we with supply? Let's just start there because there's so many headlines about oversupply in certain markets that are terribly oversupplied. Is that exaggeration or is that real?
I think it's exaggeration. I think, sellers are back to their kind of typical behavior. We're seeing this year, we had sellers return to the housing market, but buyers kind of held back. And we can get into, we heard all the headlines, so we can get into why buyers held back. But essentially, if you look at new listings in the for sale market, they're just behaving the same way they were behaving before the pandemic. The inventory, of course, because sales were kind of weaker than expected this home shopping season, inventory has risen. Inventory is now up 17% on a year-over-year basis. And we have the most homes for sale.
Did you say 17 or 70?
17 on a
17,
year-over-year
that's
basis.
better. That's
Right.
better.
That's right. And we have the most homes on the for sale market than we've had since November 2019. So the market is more balanced. Now you have more potential buyers have more bargaining power, which I think is good news. I think it makes for a healthier housing market. Of course, the trouble is still affordability. Not a lot of people can afford to transact when mortgage rates are elevated. And so, we think potentially, even if mortgage rates stay where they're at, you get some affordability improvements coming from easing price growth in many markets. That's going to help. And so, if you keep, if income growth remains kind of steady where it's at right now, about 3.8% a year, and prices decline a little bit, you see some improvements in housing affordability.
And that's where demand comes in. So we see that supply is probably healthy, nothing to freak out about with headlines saying, oh, housing crash or whatever people are saying. It's really on the demand side that people just aren't in a position to buy at the high rates, the high prices. But if one of those things adjusts, then we'll see movement.
Well, I mean, it has everything. I mean, this year at the start of the year, we expected a modest recovery in home sales. And we didn't really get much, right? In that sense, we were still bouncing along the bottom, kind of flat compared to last year. And a lot of that had to do with all the uncertainty that we got in March and April, right? We got this massive stock market correction in March and April. Businesses went kind of on a hiring freeze, right? Layoffs remain low, but hiring in the labor market's very, very low. And we know from the current population survey that the number one reason people move is a job. And so if the labor market kind of slows down or is frozen, it's going to show up in residential mobility as well. And so that's why we are, on the demand side, we haven't seen as much activity as we had hoped to see for at the start of this year. It's showing up it's in the for sale market. It's also showing up in the rental market. If you look at rent growth tends to pick up this time of year, early summer, right? Rent growth has been somewhat muted this time of year. And so you can see, right, that the trouble is, the labor market's slowing down. The economic growth is slowing. So even with the improvements in affordability, people are staying put. They're pausing, they're waiting. I always say that when people are uncertain about the future, about their future incomes, they kind of sit back, they sit on their wallets, right? They don't go out and buy a new car, buy a new house, right? Make big decisions. And so I think that's what's playing out right now. If we can get the labor market humming again, I think we're going to receive that modest recovery that we had hoped for in the months ahead.
Yes, I think a lot of people are hoping for that. All right, so I just want to bring an anecdotal story to you because I think this is where people get confused. I have a close family friend. He's in his 20s. He is in the military, is able to get his veterans loan, and he could put a very low down payment, low interest rate. He found a property in San Antonio near the Air Force Base where he is. It's a 5-bedroom house. He got, 4 other guys from the military who are going to rent from him, got a contract ready to buy. And then his lieutenant or whoever is the guy he reports to said, let me sit down with you and tell you what you're doing. You're an idiot. You're buying at the peak. The housing market's about to crash and blah, blah, blah. And it freaked him out. So he called me and he's, we're friends. So I could take that time to kind of walk him through this. But, you can see where people are, basing certain assumptions on, wow, prices are high. That means there must be a crash ahead of us. When in fact, this property was $399,000 and he's getting it for $320,000. That's not something you can normally do in a market, right? So anyway, I'd love your thoughts on that and the kind of advice people are getting from headlines, from others, from people who aren't experts. What do you say to that?
Well, I think the first thing that comes to mind is, look, I don't know, we've had maybe 11 recessions since the Great Depression, and home values fell in real terms only maybe 4 times in that period. And so when you look at the chart and you zoom out, what you see is prices continue to rise over time, right? We get these, periods where you get an economic downturn and the softness in the market, because there's a holdup in residential mobility. But ultimately, right, you get past that. And the reason we get past that is because, the Fed cuts interest rates, starts buying a bunch of mortgage-backed securities, mortgage rates drop, the federal government supports households with expansionary fiscal policy, meaning more, checks and lower taxes and more government spending, and you get past that, right? You get past the cycle. And so to most people, I say, look, there's a massive housing deficit across the country. What do I mean by a structural housing deficit across the country? What do I mean by that? You have a lot of families that are stuck living in a place, sharing a housing unit with a group that's not related to them. And if those people could afford to move out on their own, they probably would. And you just don't have, on the supply side, you look at the housing stock, you just don't have enough homes to go around for everyone. And so when you have that big imbalance between the number of people who wish they could move out on their own and the number of homes that are available for rent or for sale, you're going, as soon as you unlock those people, you're going to get price pressure, right? Unless you build enough housing to make up for that, right? According to my estimates, our housing deficit was about 4.7 million homes across the U.S. And so once we get past this stage of the cycle, prices will start rising again, even in places like San Antonio that have built a lot of housing and where you're seeing price growth really soft and it maybe even prices declining in some places. And so that, my advice is get in while you can. The best time to buy a house, if you're a young family or if you have pets, was yesterday. If you look at the people who are really comfortable, who have seen their wealth increase dramatically, they're the homeowners of the pre-pandemic homeowners who are able to refinance their loans, get a super low mortgage rate, have a very low mortgage payment, that are in some cases even pretty much living for free because basically, they saw their equity increase tremendously during the pandemic. They're sitting in the best financial position right now, both their assets in the stock market, but also their housing wealth absolutely soared in the past few years. Renters, on the other hand, found themselves with rents rising much faster than their incomes during the pandemic. At some point, rents were rising 16% on a year-over-year basis. I remember in February 2022, it was shocking to see a single year increase of 16% in rents in the typical rent across the country. And so renters are squeezed. These renters, by the way, today, most of them are younger. They're also now facing, higher credit card debt. You're looking at the New York Fed's quarterly household debt report. Higher credit card delinquencies, higher student loan debt, higher auto loan debt. They're squeezed, right? And so a lot of these young folks, renters, future home buyers, really need a lot of help right now. In order to continue to move up the housing life cycle.
Yeah, yeah, I couldn't agree more. It's times like this, it is in my opinion, the time to buy. It's a buyer's market. There's more options. There's a lot of people unable to get in. You can negotiate. Like I said with my family friend, he negotiated $75,000 off the purchase price. Were you expecting, 50% of, like what do people think is really going to happen? And when you have so many homeowners in such a strong position with 40% owning their home free and clear and another, I don't know what percentage in low interest rates, they're in the best position they've ever been
Yeah.
in. So
I think you touched on something here. It's really interesting to see that in some parts of the country today, buyers have, there's more opportunity for buyers, right? So, we talk about you're in the market and you're trying to negotiate, get yourself a price cut. We look at the Zillow Market Heat Index, and what we see there is the nationwide, the balance, the market is more neutral. But if you look at disparities across, you could differences across markets, there's huge differences. In the Northeast, you still have a ton of pressure, competition amongst buyers. But in the Sun Belt, in San Antonio, Austin, Houston, and Florida markets where I've seen a big increase in housing inventory, markets that I've seen a big increase in new construction, in building during the pandemic, are markets where buyers have a ton of bargaining power, right?
yeah.
We're looking at nationwide, the share of listings were priced was about 27% last month. In some of those markets, 40% of listings on Zillow have a price cut, right? That just tells you how the pendulum has shifted somewhat from sellers to buyers, creating an opportunity that may not last forever, right?
Absolutely. I mean, people get very confused when I ask a room full of people, what is a buyer's market? Or when is it time to buy a buyer's market or a seller's market? They get very confused about this, but because so often in a buyer's market, people want to sell. And in a seller's market, people want to buy. So understanding the differences there is so important because in both situations, the masses kind of do the wrong thing.
That's right. I mean, if you can afford it, this is what I tell people. If you can afford it, you worked out the math, right? We have a great tool on Zillow called Zillow Buyability, where you can go and put in your finances and it will show you all the homes that will fit within your buyability, right? And the best part is, it uses your credit score and it fluctuates with mortgage rates, right? To give you an idea of where you're at in the process. And so if you've done the math and you've talked to a loan officer and you're like, hey, I can actually move into this market, I think waiting could be very costly,
Yeah,
right?
like ignore the noise and look at the numbers and just focus on that. I couldn't agree more. So one of the things that could take inventory over the top, meaning bringing more inventory on the market, would be bringing on new supply. But we're not really seeing that. I mean, we've seen some markets overbuild, and those markets are kind of burning off that excess inventory as people creep into the market and start to buy and negotiate deals. But where are we seeing builders pulling out? It sounds like July housing starts climbed, but building permits fell. What does that mean?
Yeah, exactly. So I don't like using the word overbuild because again, it's a cycle, right? You're at a stage of the cycle where economic growth is slowing, right? And so the labor market slowed down, residential mobility slowed down, but it's very temporary. And so even in some of those markets, I expect the pressure to start coming up again. Why? Because you look at builders' behavior is builders don't really build into a slowing into an environment where prices are slowing or falling, or rents are falling, right? Builders pull back. And that's exactly what we're seeing right now. Builders are actually pulling back, right? You look at permits are down on a year-over-year basis. In the first half of this year, we had 6% fewer permits than we had last year, right? And so permits are telling you how many projects are essentially going to get started, right? New projects are going to get built. And builders have pulled back, and I don't expect them to come back in anytime soon. And so as builders pull back, there'll be fewer homes under construction and fewer homes coming on the market in the months ahead. And that's going to, of course, means that, there'll be pressure. The opportunity for those who wait on the sidelines could kind of go away, right? Because right now you have the price cuts. Right now you have the inventory, you have the options. But as builders pull back, you may not have as many options. You may not have as much leverage. And so if you can afford it and you've done the math and it makes sense for your finances and for your household, then this could be the moment, right? Before we start to see inventory. I mean, look, even this time of year, again, I mentioned sellers are basically doing their typical thing. Sellers are pulling back already. New listings are down 4.3% last month in July.
Wow.
It- and so I expect inventory to do what it normally does. It will peak and then it will start coming down. And when it starts coming down, well, you have fewer options. You have usually it's like kind of the stale inventory that's left over, right? That's on the market in the winter months. And so again, if you can afford it, the time may be now, right? If
Yeah.
that's time for you, if that's the thing for your family.
Yeah, when there's less building happening, and yet we have this massive millennial generation looking to buy and trying to get off the sidelines as soon as rates come down, and then suddenly, once again, we don't have the inventory for them when and if rates come down, or when wages go up or prices come down. One of those factors has to happen to create more affordability. But waiting, I guess the question people have is, if I wait, will I get better prices than if I buy now and then end up with a property that I paid too much for?
Well, going back to what we said earlier, how often have we seen prices decline in real terms,
Yeah.
and by how much? Right? If you look at the chart and you zoom out, it's not very much usually, and then you see a big resurgence in prices. And let me just kind of adding to the kind of the macroeconomics of the moment into this conversation. Look, fiscal deficits are rising, and we got a new. You look at the kind of policy agenda and what Congress is passing into law, higher fiscal deficits are essentially inflationary. And by the way, we're already seeing the producer price index ticking up, moving above 3% away from the Fed's 2% target, right? And so my fear is that, if we start to see inflation kind of pick up again, right? First, you could have some pressure on mortgage rates. Remember, regardless of what the Fed does, mortgage could still move higher. In September of last year, the Fed cut 50 basis points, and by January, the 10-year yield, which mortgage rates tend to follow, was up. The 10-year yield was up 100 basis points or so by January, right, of this year. And so a Fed rate cut in September doesn't necessarily mean that we'll get lower mortgage rates, right? And so, if you have the type of inflationary tendency that I think we're seeing, waiting is risky, right? You could end up with
Mm,
higher mortgage rates, and that will make the math even harder.
absolutely. Oh, yeah. So many people, I think if we collectively intend that mortgage rates come down, they will. That's just not how it works. Everybody's waiting for that moment. You have to also consider they might not, or they might go up. And wouldn't you be so sad if you couldn't brag that you have a 6.5% rate when everybody's got a 9%? Not that it's going to, but rates are pretty low, really, historically speaking, right now.
Yeah, that's right. I mean, look, we're below 7%. Great. Rates have actually been easing since May,
Yeah.
right? And they've been easing ahead of this, the market's anticipated Fed rate cut. This is almost fully priced in now. And so I don't expect the rate cut to actually yield further mortgage rate decreases necessarily. So again, I don't think you get a big improvement in affordability from rates. Hopefully you get a little price decline. And I think a price decline might actually be a good thing, because it will actually allow a lot of people to come into the market. You get a little bit of that. That's going to help people come into the market a little bit. The market is getting healthier and healthier. A healthy market is one that's highly liquid, where people who want to trade can easily trade their homes. Remember, affordability is a challenge, not just for buyers, but also for sellers.
Yeah.
One, sellers want to buy again, right? But also sellers want to people who really want to sell really want to be able to find a buyer on the other side of that transaction. And
Yeah.
so that's what we say, affordability is a major issue. And so I think that price correction is kind of welcome. Most sellers are sitting on near record home equity, and they can actually afford to cut their prices a little bit.
Hmm.
Uh, and so I think, with more inventory than we've had in a long time, with more buyers having more bargaining power, we are getting back to a healthier market. And whatever price correction is taking place is actually a necessary one that's somewhat healthy.
So we know that there's no one market. I'm sure you talk about this all the time. So are there markets that are healthier than others, and some that are just flat unhealthy?
Yes, I mean, look, I think ultimately markets that continue to build housing and where you see stable price appreciation are healthier markets. Those are markets where demand comes in and supply moves along with demand. Remember, the way markets work, right? Demand increases and you get a natural response in supply, right? Like
Mhm.
you get a big increase in housing demand, prices shoot up, and builders don't leave any money on the table. They start working again, right? To kind of capture some of that. And then they build enough housing, and price is growing kind of at a stable pace, at a
Mhm.
moderate pace, right? Unhealthy housing markets are the ones where demand comes in looking for housing, but builders are unable to respond to the surge in prices, partly because of, roadblocks to building housing. It could be geographic roadblocks, but very often it's that and man-made roadblocks, such as minimum parking requirements, minimum height, lot size, policy roadblocks that prevent them from building into and leaning into higher density. Look, if more and more people want to move into cities, there's no reason why we shouldn't be building more townhomes, condos, and high rises, right?
Mhm. Right.
Builders go where demand is, and if you're not seeing the big response in new construction, it's usually because there's some inefficiency, right? Some friction that is making the market less efficient and less healthy as a result.
So which particular metros would fall into those categories? Which ones would you say are healthier at this time and builders are it's more stable, prices continue to rise and builders are doing all right?
I love the Carolinas, and I
Yeah.
mean, I recently moved to North Carolina.
You're a
I
statistic now. You're one of those moving out of the West Coast to the
I
Southeast.
I love the Carolinas. I mean,
Yeah.
stable price growth. You're seeing a big inflow of tech workers to the Research Triangle Park area,
Yes.
and you're seeing builders responding to that demand, and the market is growing as a result. It's healthy, right? By contrast, you look at the Northeast, and people move to the New York metro area. They move to the tri-state area. They want these jobs.
Yeah.
There's great industry. There are great colleges, all right?
Mhm.
Connecticut, Massachusetts, New York. And yet, you're not getting a strong enough response on the supply side to meet this demand, right? The most important reason in that region, you look at the housing inventory is very old. It's
Mhm.
because we're not able to build housing there. Too many rules, zoning rules, land use restrictions that basically shrink the size, kind of buildable land. If you have less buildable land, well, the cost of land goes up faster, right? And so I think that's the problem. In the Northeast, we have a great, my favorite new metric is this, it's on Zillow, is we look at the engaged shoppers per listing. Basically what it does is it looks at the share of shoppers that are basically are saving and sharing, like actively saving and sharing listings on the platform, right? And when it's basically a measure of tightness in in the housing market. In the Northeast, you have markets where you have more than 10 engaged shopper per listing, whereas nationwide the average is about 5.5. And in some of the markets you highlighted, like in the South, it's actually less than one, right? It's like 0.6, 0.7. You have fewer shoppers per listing in some Texas markets, for example, right? That have built a lot of housing. And so we need more construction in markets where you're still seeing a lot of demand for housing.
Yeah.
And it's just so slow to come. I've done some research on this, kind of highlighting how responsive builders are
Yeah.
to the demand surges.
You don't have to tell me that. I'm in California. I know how hard it is to bring on new supply, and thus we have very high home prices. People think that there's just, not enough land, and that's not true. There's plenty of land. You just it's really hard to build on it. Obviously not in San Francisco and on the peninsula there, but when you just go outside a bit, there's plenty of land.
Yeah.
All right. So if you were to be buying investment property today, what areas would you say make the most sense and that would have the most upside at this point?
I usually say when builders are able to build, right? Follow the builders. The builders are so good at forecasting housing demand because their livelihood depends on it, right? And I mentioned, unfortunately, there are roadblocks to building in many markets. You want to go where the price to rent ratio is low, right? I want to buy cheap right? And be able to get a nice enough margin on my rent so I can
Yeah.
cash flow. I mean, that's the general idea. And so,
Yeah.
some of these Midwest markets, you look at single family permits in Kansas City, for example, it's amazing. I think they're still up quite a bit relative to a year ago
Mhm.
because it makes sense to
Yeah.
go there, right? And so relative affordability, where prices are still rising at a rapid pace, prices and rents are still rising at a relatively more rapid pace. Those are the markets where I would go. So I really like some of these Ohio markets. I love Columbus industry, younger workforce. If you have a younger workforce, you have a relatively stronger labor market, you have
Mhm.
relative affordability, a low price to rent ratio, and you're close to a major market, you
Yes.
want to be there, right? As a
Yeah.
housing provider.
It's so funny to see the ebbs and flows of real estate. I've been doing this so long, and you'll see the hot coastal markets, the expensive markets, be the place, and then they get too expensive, and all of a sudden the shift is to the more affordable markets, and that's definitely what we're seeing. We just had a leadership meeting today at Real Wealth, and kind of looking at the numbers, and for the first time, the bulk of buyers, and we have over 88,000 members, so we really get to kind of see bird's eye view what people are doing, what they're buying. It's exactly what you just said. The Ohio markets, the Indianapolis, the Kansas Cities, the more even parts of Texas and in northern Dallas, where just like you said, it's near a major metro, but if you go out far enough, it's still affordable and they can do that commute. So 100% that's what we're seeing on the ground as well. Oh, there are so many questions. I think I made it through 3 out of like 20. We just have to have you back. Is that okay?
I think we could work this out, before we go, I just kind of want to, some of the biggest misconceptions that I get every time I talk to housing providers, especially like, investors, they have rental properties and they invite me and they just want to talk about the rental market. Say, I
Yes.
want to know
Let's
what's
do that.
going on in the rental market.
Yeah.
And the one thing I want to tell people is you shouldn't just be tracking the rental market. You should
Mm.
also be tracking the for sale market.
Yes.
Ultimately, people just want the biggest bang for their buck, especially at a time where affordability is stretched, right? Our surveys show that renters and buyers alike care about budget number one above any other amenity, right?
Hmm.
The other thing that people don't realize is that Zillow data tells us that roughly 24% of those people who started out looking to buy a home ended up renting instead. And in 2024, and 58% of recent renters said they thought about buying a home first. And so you actually want to be looking at both markets and you want to be advertising your listings on large platforms. And of course, I'm going to mention Zillow here because we're really capturing both of these audiences, right, on the platform. And it's easier to get to fill your vacancies, your rental vacancies, by being on a platform where you're getting, because people are looking at everything.
Oh, yeah.
Right? And so when you get in a for sale market, for example, like this year, when you get an increase in housing inventory, the increase in housing inventory gives buyers more bargaining power, but also renters. Remember, renters are potential home buyers. They also have more bargaining power, right? And so those renters are looking at all of the options that are available, not just the for rent market or the for sale market. So I think that's one message, clear message for people out there, especially the investor community, that look, you got to be looking at both. You got to be well versed with both the for sale market and the rental market, because your next tenant might actually be out there looking to buy first and then finds a great deal and ends up coming to fill your vacant unit.
Yeah, I mean, I feel like that goes without saying. I think I'm on Zillow every day. I just assume other people are too, because it is such a massive platform with so much data. And I personally just want to thank you for all the data that you share with us little folks, so that we can stay on top of things and make smart decisions. Thank you. Thank you so much for being here on the Real Wealth Show.
Thanks for having me.
And thank you for joining me here on The Real Wealth Show. If you'd like to learn how to get your first rental property and negotiate a great deal, visit realwealth.com/90 days. That's 90 in the number, 90 days. We've made a PDF for you to show you how, and it's free. Again, that's realwealth.com/90 days.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.